Thank you. Can you switch to the next slide, please? Okay, so I'm going to start. A lot's happened on this topic of what Congress is trying to do. I'm going to start with history and then move forward. So you might have heard this before, but it's important to talk about it now because it's going to get crazy after I speak for a while. The Biden has two plans out there that he wants Congress to pass. The first is the American Jobs Plan. It was released on March 31st. It includes over $2 trillion of tax increases. Those are on corporations and the fossil fuel industry. Later on, this price tag was lowered to 1.7 trillion and is now maybe $1 trillion, but things have happened today that these numbers may not matter, but it's just important to keep them in mind. The second plan that he did is the Americans Family Plan. This is considered, well, let me go back to the jobs plan. That is a infrastructure proposal. It is roads, it's bridges, it's that kind of thing. Then the American Families Plan is what is in Washington called a soft infrastructure bill, which is geared toward childcare, free community college, helping families with elderly, that kind of thing. It was released on April 28th. It includes 1.6 trillion of tax increases that go toward wealthier taxpayers, and it also seeks to increase tax compliance. Originally, the increase in tax compliance was a part of the Families Plan. There's been no real discussion on this plan yet. And to be honest, both of these plans, there is no legislation written for these plans yet either. Now, you're going to see next week that the House is going to pass what they're going to call an infrastructure bill that is going to be touted as the American Jobs Plan. That is not the American Jobs Plan. It is a spending bill that's going to be tied with a water spending bill. And so they're going to pass that, I believe, on Thursday of next week before the House leaves for the 4th of July recess and say we passed the jobs bill. White House press secretary has said this is not the jobs bill. So just keep that in mind that when you read that the House passed an infrastructure bill, it's not this one. That is a long way from ever happening. So, so just to restate, there is no bill for either of these plans yet. Can we go to the next slide, please? Okay, so this is what happened when Biden introduced the American Rescue Plan, which he did on January 20th. Now that plan had no tax increases whatsoever. It provided $1.6 trillion in relief that pretty much extended what happened in 2020 with prior relief packages. It became legislation on February 18th, less than a month later. And it was signed into law on March 11th. So the rescue plan went from literally a proposal to law in 50 days. We are way beyond that for both of the family plan and jobs plan. So what we're looking at is a much slower pace on how Congress is going to filter through and find out what they want to pass with these with these and what they don't want to pass. And like I said before, right now there is no bill. Can we go to the next slide, please? So this just kind of lays out what has happened since the American Jobs Plan was released. And Biden met with the Big Four. The Big Four are the majority and minority leaders of Congress. And there was no agreement at that meeting, and it literally was one meeting, and it went nowhere. And so Biden said, okay, I have to look for someone else to deal with. Well, Senator Capito and other GOP members said, we'd like to work with you on this package. They started doing this weeks ago. And every single meeting, they couldn't agree on how to pay for it or what even to include in it. because basically the Biden administration wanted to include other things like the soft infrastructure, the daycare kind of things into an infrastructure plan. And the Republicans were saying, no, we don't want that. They literally met for hours sometimes and couldn't agree on basics of what's in the bill. That is just, anyway, it's just kind of infuriating. And so what happened was that the Republicans said, well, we don't want tax increases. And so Biden said, okay, I'll take off the increase in the corporate rate. His plan, the corporate rate would go from 21% to 28%. And they're like, we're not going to have that. Well, there's also other tax increases in that bill. So taking off one, I'm not understanding what the logic was there, that they were said that the GOP would suddenly accept the other tax increases. It doesn't seem to make sense to me. And it didn't make sense to a lot of people because no agreement was reached in that thing after weeks of literally talking about the same thing. So what's happened since then is that a group of other people have come together, and the number 3 here, we're going to go into more depth on that later. But it had 21 senators. It was 11 Republicans, 10 senators who caucus with Democrats, agree on a plan that was 1.2 trillion over 8 years. And it at the time, it included $579 billion of new infrastructure spending. Now, this is the hard infrastructure. This is the roads, the bridges, that kind of thing. None of the soft infrastructure. It also included no tax increases. And that's kind of not really true because they called them fees, which it's still money out of your pocket. But the Republicans wanted to do this with paying for it with gas increase in gas taxes, which they said are fees. So, you know, what happened with this bill, we will go on later, but let me go down to number 4. This is a 58-member bipartisan House bill, once again, on hard infrastructure. And they were doing something that was very similar to what the senators were doing. In fact, it had a lot of overlap. And so the Problem Solvers Caucus was working with the 21 bipartisan senators to actually work on one single plan. But again, the 58-member is bipartisan and it had no tax increases. And so when you look at number 3 and number 4, the thing to really notice is that there are Democrats supporting legislation that has no tax increases on income. Let's just say that for argument's sake right now. So that is an important thing because you have a number of Democrats saying we don't need tax increases here, and the majority leaders, which are Democrats, are saying we need tax increases, but their rank and files are saying no. And so there is kind of a separation there with what's going on. So can we go to the next slide, please? So this is where we are. As I told you, that 21-member GOP bill that was on the previous slide, that has now had an agreement with officials at the White House. And so what this is it is a, I have to look at my notes because it just actually literally happened. Well, let me back up for a second. This is kind of funny. So when this deal happened, that the White House officials agreed with it's actually a 10-member Senate group. It wasn't the full 21, it was 10 members, but it's the same plan. When the members were asked, is there an agreement? A quote from Senator Hollens, a Republican from Maine, said, "I'm optimistic that we had a breakthrough." How are you optimistic? You're in the room. What happened? White House press secretary said that progress toward an outline of a potential agreement was made. That's not an agreement. And Senator Thune, Republican senator from South Dakota, said pay-fors are complicated. Now, other members who came out of that meeting said it's fully paid for. So right now we don't know what's going on. And literally as we speak, these members are talking to Biden about their plan, because the White House officials has signed on to it, but Biden has yet to sign on to it. And that's the big one. And so that's literally happening as we speak, which is why I turn over, because that's where my TV is, and I'm seeing if something's being said on that. But anyway, there is a question as to why this all would be happening right now, when there's been no real headway for literally weeks. Well, the Senate's last day before the July 4th recess is today. So this is the last time they can actually do something. So it does kind of seem like they're just trying to make a win happen, when actually it's really unclear where this bill is going to go. And let me go into more detail on that now. The bill that they've agreed to is, and there's options here, and sorry, I have to look down my notes. It's $559 billion for 5 years, 1.2 trillion for 8 years. And no matter what you're doing there, it's 559 billion of new spending on hard infrastructure, roads and bridges, that kind of thing. Now, this is supposedly fully paid for, and the details are not out there yet, but supposedly one of the biggest pay-fors, and this is not confirmed yet, is bringing back the Superfund tax. And that is a tax that petroleum companies, chemical companies, they all pay into this fund that will fund when something spills, when there's a problem with a chemical spill, when there's a problem with an oil spill. The Superfund will go do that. And so they're thinking about bringing that back. They're also, and this is where it's unsure, the increase in the gas tax, which the GOP wants, the Democrats don't, because it would affect people making less than $400,000 a year. Biden has promised to not affect anybody or not increase taxes on anyone making less than $400,000 a year. Well, when you fill up at the gas station, there's no way you're going to show your tax return to get gas. And so that's out. The Democrats want to increase IRS enforcement and basically audit richer people and corporations. There's a problem there, and it gets really tricky, but essentially they would not change the law. They basically would just make the IRS, they would give the IRS more money to go enforce the current law. Well, under congressional rules, if the law hasn't changed, then you can't make it score. The money that it raises cannot be changed because you didn't change the law. And so what they're dealing with is that they say it could bring in $700 billion extra dollars over a 10-year period. Well, if you don't change the law, then there is no $700 billion. And so right now they're working on how to create a provision that would basically increase IRS enforcement, that would allow them to show the money that they raised and be within congressional rules. It's all very dicey at this point, but this is the track one that's on the screen right here. And this one will need Republican support. So what they want to do here is Biden wants a bipartisan deal badly, extremely. He really wants one. And this is what he hopes to get. And so what would happen here is that because there would be arguments against this bill, it would require 60 votes to pass the Senate. Now, the funny thing is that 11 Republican senators are already on board with this bill. So you would think, okay, well, you have 50 Democrats in the Senate. All you need are 10 Republicans, and you've got 11 signed on to this bill. So it would be easy. It's not going to be that easy. The reason why is because many Democrats don't support the track one bill because it doesn't deal with the soft infrastructure. It doesn't increase taxes on the wealthy and on corporations. And so they don't want to support that bill because they feel like you're just going to get the bipartisan bill done, and then we're just going to move on with our lives. And so right now, I've been speaking with some people on the Hill, and there's a thing called a whip count. And a whip count is basically people go and talk to lawmakers and say, would you vote for this bill now? Well, based upon what the whip count showed, it would be, they would need 25 Republican senators to actually support this bill for it to pass the Senate with 60 votes. Well, if the Superfund tax is paying for this bill, which essentially taxes petroleum, chemical, and other sort of companies, that could hurt a lot of constituents that have Republican senators. And so there's a question as to why are you using the Superfund tax? And again, the details aren't out here. This is just rumor. And so what has to happen is what will happen is that paper will be released later today, and then more details will be had, hopefully. So anyway, what track one is basically the most written up bill that's happened, and it's basically the American Jobs Bill. Now I'm going to move on to track two, which track two is literally past everything else that couldn't make it in track one. And this basically means it is pieces of the Jobs Bill that didn't get into track one and all the American Families Bill. So there are two people working on the track two legislation. They're the budget chairman, and that's Bernie Sanders in the Senate and Yarmouth in the House. These guys are on the same page when it comes to what track two legislation should look like. And it is expected to cost $6 trillion over 10 years. It will address the SALT cap by partially repealing it for people earning less than $400,000 a year. And it will include $2.4 trillion in new tax revenue, which would be many of the tax proposals that were in the Jobs Bill or in the Jobs Plan and the Families Plan that Biden released earlier this year. And so they're going to work on this, and their plan is to take this bill through what's called reconciliation. Big word. It means a lot of things, but for the most important thing here is that it means that when you have reconciliation, the Senate only needs to have 51 votes to pass something. So the Senate has 50 Democratic senators, and then if there's a tie, the tie can be broken by the vice president, who is Kamala Harris, a Democrat. So she would come in and break the tie, and then it would have 51 votes, and then it would pass. But before all that happens, this bill has to go through a budget process. So on July, the week of July 12th, the Senator Sanders and Congressman Yarmouth are planning on creating a budget that would include the reconciliations instructions that would allow the $6 trillion, $2.4 trillion tax increase bill to go forward in the budget process. So when they do that, you first have to agree to a budget. And so both chambers have to agree on the same budget, because if they don't, it's going to take more time than they need to actually do this. And so they have to first agree on a budget. Once that budget's agreed to, which Senate Majority Leader Chuck Schumer said should take 3 weeks minimum to actually just get a budget. Then once the budget is agreed to by both chambers, it doesn't have to be signed into law, but then the committees can then take the reconciliations instructions and start creating the actual legislation that would give $6 trillion in spending, $2.4 trillion in tax increases, and start working that through their committees. Once that's done, they then have to put those bills together and then go to the floor, and there would be, it's a thing called the vote-a-rama, where when the budget goes to the floor, they can add amendments to it if they want. And then with reconciliation, you're not supposed to be able to amend it. But for some reason, sometimes they find some sort of thing to try to amend it, but you're not supposed to. But in the Senate, there's a rule for everything, which means there are no rules. And so sometimes they can work this out so the debate is actually longer than it should be. So what we're looking at here is two bills that have not been written yet at all. And the first bill is possibly had some agreement. The second bill, there is no agreement. There really is no paper on it whatsoever. And so moving these forward is going to take a lot of finesse. And so today, literally 15 minutes ago, House Speaker Nancy Pelosi was asked that her progressive Democrats in the House do not want to vote on track 1 until they know that track 2 has passed. And so they are calling for track 2 be voted on first in the House and not track 1. Well, Pelosi today said that the House is not going to touch either of these bills until they both pass the Senate. So it becomes a very long situation, because the Senate could say, well, we want to make sure it passes the House, so why don't you guys go first and not us? So there could be a back and forth to that, because there's a lot of people, a lot of Democrats that actually aren't really on board with a lot of the provisions that are in here. And they're being called to support something that they don't really want to do, because basically it could hurt the reelection in 2022. And the bottom line for every lawmaker I've ever spoken to is, if it doesn't help me get reelected, why am I doing it? And these two bills are just ripe with problems for Republicans and Democrats. And some of the reporters that I speak to that follow this stuff closely are really starting to wonder if these two measures are even going to pass. But we're not going to even know that until at least September, because Congress has got to deal with other things before this happens. And I'll do this quickly. There is a thing called the debt ceiling. The debt ceiling is how much, like, we can only issue so much debt. And right now, I think it's like $28 trillion is the ceiling. Well, there is no ceiling right now, but anyway, so that time when they have to address the debt ceiling is going to come up on July 30th. And so after July 30th, they have to reset the debt ceiling. They might have a few weeks to do that, but it's going to be a really fierce fight. And the problem that a lot of Democrats, especially moderate Democrats, are going to have is that they're going to try to increase the debt ceiling while also trying to pass a $6+ trillion bill. That doesn't work politically. It is easy to bring this up to a Democratic lawmaker and just say, why are you supporting more debt? And they'll say, oh, well, no, well, we're going to offset it. Well, the $6 trillion bill, if they have $2.4 trillion of tax increases, it's not even half paid for. And right now, that's the plan. And Sanders has also said, why don't we just do it all on deficit, so that way we don't have to deal with anything else at all. So it's a lot going on. And I would just focus on the negotiations for the track 1 bill, which is the hard infrastructure bill, that basically will have detail on it maybe tomorrow. So can you go to the next slide? Okay, these are the upcoming hurdles I want to talk about. Now, the eviction notice might have been addressed today by Treasury. Oddly, its links would not work to what it's doing, so I couldn't read it. So I'm sorry about that. The debt ceiling, they have to deal with something by August 1st, maybe mid-August. Funding the federal government's going to be hard. That's by the end of September 30th. And then a bunch of tax cuts are about to expire. That's at the end of the year, and no one is looking at that right now at all. Trust me. So I just got a note that Mel wants to bring something up. So Mel, if you want to come on board, come on board.
Very good. Very good, Jay. I very much appreciate, and I think it's important to focus on what Jay has had to say, particularly with respect to what this means as far as timing, as far as the possible inclusion of items here, certainly in the near term. But I would be careful not to assume that this means that those provisions that have been put on the table by the administration in other ways through this discussion, those items are on the table. Things that go on the table in Washington have a tendency not to come off the table. Sort of a truism is that there are no new proposals. There are only proposals that are being recycled from some time before when they did not get included. And so we're going to turn now from the discussion that Jay has been presenting as to where we currently are with the debate over tax increases, the debate over budget items on Capitol Hill, and look back again at some of the important items that are on the table, may not be, certainly are not going to be included this week. Jay's made that very clear, and there's certainly no question about that. But something that we could be seeing wander its way back into the process later on. And with that, one of the more important, I think, is the whole question of how this may affect long-term planning with regard to wealth, with regard to estates, with regard to gifting in the process to try and preserve family wealth. And for a discussion of that, I'm going to turn things over to Ava Archibald. Ava, you ready to join us? Oh, yep. I take it back. We have gotten, it is, let's stay with this. I may have interrupted Jay here. This is the graphic that shows exactly the timing issues that Jay has been talking about. And let's focus there. Let's focus on August. Yeah. There is a huge amount of white space in August. And yes, occasionally congressional leadership threatens that the members cannot go home and play. Sometimes that works, sometimes it doesn't. But when you look at this, particularly if you're talking about something being done before Labor Day, there's just not a lot of colored spaces. The yellow ones are the only days when both of the chambers are scheduled to be in session. And what are we looking, Jay, here? Looks to me it's like there are
4 weeks. It's
4 weeks.
weeks.
No, let's but in fact, full session is not even, it is 9 days between now and Labor Day.
Yeah.
I take that back. We got to count today, make it 10. We're counting today, we're going to make it 10 for both houses to be in full session. And I think that just that just reinforces the comments that Jay has made about timing with respect to this. But you know, strange things happen in Congress as time goes on. So we may all be back here to reconnect come Labor Day and see where we are going from then. And with that, Ava, as I say, I think that there is still we still need to be conscious that this stuff is there. We still need to be conscious with helping clients and helping taxpayers to plan. So why don't you talk to us a little bit about, given this situation that Jay states, you know, we don't really expect anything, certainly not tomorrow. What sort of wealth planning really does make sense in this era of uncertainty?
You know, that uncertainty, that's the word I hear every day. And that's what people need to consider. So anytime we're doing planning with wealth, I'm the principal in charge of our wealth transition services. So we have a core team in our firm here that works every day looking at transitioning wealth down to that next generation. Maybe it's succeeding that closely held business down to the next generation. And as accountants, we're doing that and looking to do that in the most tax efficient manner. But with the threats of these proposals, we don't want people to transfer this wealth and then regret it later. So we want to plan for the laws we know today. We know we have some sunset provisions coming under the current laws, and we want to be aware of the proposals so that we're ready to address those proposals if they actually do go through or a portion does go through. So Amy, I think I'm going to try to take control of my own slides. There we go. So with that said, I'm going to touch on just a couple of the proposals that are out there. There's the 99.5% Act, which was introduced by Bernie Sanders, which addresses the exemption amounts and some estate planning techniques. And then we have the STEP Act that Van Hollen brought regarding basis and how we basis and gain on basis, let's say, is triggered either on a transfer at death or during life. And then the American Families Plan, which was the Biden administration, which was clarified here May 28th with the Green Book, that also addresses this transfer of assets either during life or at death, and how you're going could trigger the capital gain tax on those transfers. But before we get into that, I think it's good that we know where are we today with the law we have it as today. Because as I said, let's plan for the law we know today. Let's plan for where these sunset provisions may be coming under the current law and know what the proposals are in the background. So today, estate and gift generation skipping tax exemptions, they're all the same. It's 11.7 million per person. So you can transfer that wealth during your lifetime or at death and not pay any gift or estate tax. If you do pay tax, it's at 40%. And we have still available to us, even throughout all these proposals, portability, which I'll touch on a little bit in more detail in a few minutes, but that's a leftover exemption of one spouse can be made portable or transferred over to the surviving spouse if not used during lifetime or at death by the first spouse. We know under the current law that this 11.7 million, that is the highest it's ever been, is going to sunset back down on January 1, 2026 to an amount of $5 million indexed for inflation when that law came about with the 2017 tax reform. We think with inflation, that exemption amount in 2026 is going to be somewhere about 6 million to 6.5 million per person. The annual exclusion amounts is 15,000 per donee. So I mentioned the exemption amount is 11.7 million, but everybody has a freebie, let's say. They have an exclusion, 15,000 they can give to anyone they choose to, and it doesn't touch their exemption amount. It's a $15,000 free gift they can give every year. And we have carryover basis, which is important. That means if I die with those assets today, my children are going to get a new stepped up tax basis in those assets to the fair market value of the assets as of today. If I gifted the assets today, they would get my original tax basis. So I come from a family farm, and that land was inherited down from the Depression days, has very little or no basis. It would benefit my kids if I die owning this land and then they receive it on my death and they get a stepped up tax basis. So let's start with this 99.5% Act. That is going to possibly change where the exemptions now are the same between the gift and estate tax exemption. Under that proposal, the exemptions for estate and gift tax are different. The estate tax is at 3.5 million and the gift tax would be down to $1 million. So if I gifted during my lifetime, I'd only be able to gift $1 million before that gift or estate tax would be triggered. There's a progressive tax rate that increases up to 65%, not until you get to the first $1 billion, but it progressively gets higher up to that 65% tax rate. Portability still in play. Again, that's great. I'm glad that no one's trying to take away that. I think that's a great benefit for our taxpayers. The annual exclusions may change. In the proposal that Bernie Sanders put forth, It states that an aggregate annual exclusion for transfers to trust, partnerships, or items that are not immediately liquidated cannot exceed the double annual exclusion. So in the estate planning world, many times we have clients who have a trust for grandchildren, or they have a trust that might hold life insurance, and you may gift annually to these trusts. In the life insurance trust, many times we see people gift cash to the life insurance trust, and they use that to pay the premiums within the trust. As long as that's held in the trust, you can keep it out of your estate for estate tax purposes. Great deal. But if we limit those annual exclusions, that could cause a problem. Now, if somebody was going to gift more than 15,000 times 2, because you can double it going to a trust, a partnership, or an asset that's not immediately liquidated. So you could gift as much as 30,000 to that trust, but then you're limited. So that might change planning for some people. The effective dates of all these changes are December 31st, 2021, which is great and lets us have a little bit of planning available to us. In addition to those exemption amounts that all take place December 31st, 2021, if that passes, that proposal also addressed terms for GST trusts. So GST trusts are trusts put in place that we want to transfer for future generations. And in some states, under state law, you can transfer assets or leave them in trust forever. They're called dynasty trusts. They just keep going. The IRS wants to limit that to 50 years. And limitations have been in prior proposals before, but this one is limiting it to 50 years. Grantor trust rules are addressed, where that's you could transfer assets to a trust and get it out of your estate for estate tax purposes, but still make it taxable to me, the grantor, the person who gifts it or transfers it, for income tax purposes. It's a great tax play. IRS is saying that's no longer the case. Those grantor trust rules would change, that if you have grantor trust terms, then that's going to be includable in your estate when you die. If you have a grantor trust in place and you add additional assets to it, that might trigger it to be treated as these new rules, under these new rules. Or if you make distributions out of those grantor trusts that are pre-established. So that's going to be a big item to watch. Another thing they have on their table is what's called a grantor annuity trust. It's called, we think of it as an asset freeze technique in our world, where I can transfer assets to a trust today at its value today, and I take back an annuity stream for that value. So easy example, I transfer $1 million into a trust today. That trust pays me $1 million over time. I don't use any gift tax exclusion here because, or exemption, excuse me, no gift tax exemption, because I'm going to get the $1 million back. But if that $1 million doubles to 2 million, the 2 million's out of my estate. Great estate planning technique. The IRS wants to extend the term of those grantor trusts, because you have to outlive the term of the trust, so they don't want it shorter than 10 years. It must be 10 years or more under the law. And also they're not, they're changing the terms so you can't zero out that gift. The other thing on the table, and this one I think people want to watch, is evaluation rules. The first thing we look at when we're working with a client for estate tax purposes is how can we compress the value of their assets. And for gift and estate tax purposes, the IRS currently will allow you to take lack of control, lack of marketability discounts when you don't own 100% of, let's say, a company, or I don't have control of that company. Here under this proposal, they're going to restrict some of those discounts. Specifically, they're looking at non-business assets, and those non-business assets held in, let's say, this closely held business would not get the discount. So we'll want to watch the rules, see where that plays out. Now, the American Families Plan, that's the one that the Biden administration had put in place here in April, and the Green Book came out in May, clarifying some of the terms. This is where they want to change the rules on a stepped up tax basis. So now When I gift assets, where before where I said if I would gift my farmland to my children, they'd take my low basis, but they wouldn't pay tax on that until they sold the land. Here, you're going to pay tax when you gift property to someone else. So I gift my asset. They're going to look at the difference on the fair market value of the gift and what it is, what my basis was, and they're going to have to pay, or the donor is going to have to pay tax on that gain. For a decedent, if I die with my farmland, as an example, has a low tax basis, I die with a high tax basis, that gain, that is going to be taxable to my estate when I die. So no longer a stepped up tax basis. How this would be reported, it isn't quite clear. The language in the Green Book was not clear. It specifically stated the gain would be taxable income on a federal gift or estate tax return or on a separate capital gains return. Well, income tax isn't what's reported on a gift and estate tax return. That's gift and estate tax. Gain would be reported on an income tax return, assuming it's going to be the decedent's final 1040. Maybe there's a separate schedule they'll have to report that gain, but it does say that the use of capital losses and carry forwards from transfers at death would be allowed against capital gain income up to $3,000 of ordinary income on decedent's final income tax return. That was reassuring to say this is going to be on the income tax return, because where you can take $3,000 of loss against ordinary income currently on your personal return, they're going to allow that to happen with this gain triggered. And the tax imposed on the gains deemed realized at death would be deductible on the estate tax return of the decedent's estate. That leads me to believe that we're going to have the gain calculated on the final personal return. Then you're going to get to take a deduction on the estate tax return. It isn't real clear. I'm kind of reading between the lines here and listening to other commentators, but that's what it sounds like. I've had questions and comments where others have said, well, this isn't so bad because I get the income tax. Sure, I'll pay the income tax. But if I owe estate tax, I'll get an estate tax deduction. It's a wash. It's not quite a wash. I have to pay the income tax on that capital gain, the capital gains tax, and then I get to take the deduction for the tax, but that deduction on my estate tax return, remember my estate tax is at 40% starting where we are. It's not a dollar for dollar deduction. It's only reducing my estate by 40%. So it's still going to cost us some dollars. The stepped up tax basis does have an exclusion amount. There's $1 million per person or $2 million per married couple. So that's a benefit. And that exclusion is in addition to transfers of tangible personal property, transfers to a spouse, charity, the capital gain on small business stock, and the capital gain we have on a personal residence. There's an exclusion we have currently of $250,000 per person, $250,000. That is also going to be available. There's also exclusion for family-owned businesses and farms if assets are given to an heir who continues to run the family business. In the American Families Plan, it talked about this family-owned business and farm deferral of gain, but it didn't say how did we get there, who has to farm, how long do you have to farm, how long do you have to own the business. Well, in the Green Book, it's the heir must continue to run the business of their farm to defer that gain. In the Green Book, it also talks about a 15-year deferral of payment of that capital gain. That isn't quite clear either, because under the rules as we have it today, if I own a family farm or a closely held business, I can make an election if I have a family member stepping in and to pay that tax, estate tax, over 15 years. Here in the Green Book, it talks about paying this capital gains tax over 15 years, but only if you don't make this family election. So that makes me believe that this might be for family-owned businesses and farms that don't have an heir stepping in, or it's not passing to a family member. Because when this came out, I was a little concerned about that, because we have a lot of businesses who, you know, have left the farm, the family has left the farm. None of the children want to run the family business. If we're looking at $1 million exclusion per person, that's not that much gain on some of these farms or closely held businesses. And that's going to really affect a lot of Americans, not just what some people may refer to as wealthy Americans. So I hope this 15-year extension is going to help those people. We'll see what comes out of that. The gain unrealized appreciation recognized by an owner of property held in a trust, partnership, and other corporation, that can only be unrealized for 90 years. So we can have sometimes these dynasty trusts, or say an entity like a partnership, where there is a significant amount of appreciation in the assets, but that's never sold. So there's no gain ever paid. The IRS, not the IRS, excuse me, Bernie Sanders take that back. In the Biden administration, in the American Families Plan and the Green Book, are saying that they are going to have that taxed every 90 years. There'll be a triggering event starting on January 1st, 1940. So your first trigger event would be 2030. So you're not going to let that gain just roll in some of these dynasty trusts. If this passes, it's actually going to be triggered. The $1 million will be indexed for inflation after 2022, and portability to the decedent surviving spouse would be available. That's great. The effective date is noted in Biden administration, under the Biden administration, to be December 31st of 21 for the gains on property that's transferred at gift or at death. But the effective date of the assets going into a trust or a partnership, that's January 1, 2022. So then Hollens Bill has many of the same provisions that we see in the American Families Plan, just tweaked a little bit. But the interesting part there is then Hollens went back to December 31st of 2020, which would be retroactive. That seems very unlikely. If this would go through, we're looking at December 31st, more than likely, of 2021. So allow some time to plan. So actions to consider. I'll go through these kind of quickly, but portability. With this exemption at the high amount, and it might drop to possibly 3.5, if your planning documents don't address or don't allow for portability when that first spouse dies, to take that unused exemption made portable to the surviving spouse, you might want to change your planning documents. If you have a spouse that dies right this year and you're thinking, I'll never get to 11.7 million, well, will you ever get to 3.5 million? Think about that, because if I die today with 11.7 million and I make that portable to my spouse, that does not drop. He will always have the 11.7 to use. It doesn't change if the law changes. We don't have clawback. So if I use my 11.7 today, and then the law changes to 3.5, the IRS won't be able to come back and penalize me for that. There were final regs issued in November of 2019 that said the estate tax exemption at death is computed using the higher of your exemption applicable to gifts made during life or at death. So we don't have clawback issues as it stands today. Also, a thing to remember is that your exemption you use is from the bottom up. So if I think I can use 6.5 million and I get everything above that with the 11.7 million, if it drops, that's not the case. If I gave 6.5 million today and it dropped to 3.5 million, when it drops, I have nothing left because you use the exemption from the bottom up. Capital gains rates and higher income earners. There's a provision here that indicates that long-term capital gain rates and qualified dividends with an AGI of more than $1 million will be taxed at ordinary income tax rates. So that could make a big difference if these capital gain rates become effective on gift or estate plans. We're talking maybe 37% in the high bracket. And if you add in net investment tax, maybe it's 40.8. There is a provision there that indicates that that $1 million would be $500,000 for married filing separately during your lifetime. But this leads me to think about, you might want to manage some of your capital gains. If you know you're going to have a lot of capital gains if I gift or at death, maybe you start harvesting those and taking some of those gains over time. Do some planning with your advisors to see how best can you spread that out, and maybe keep yourself under that $1 million threshold where you bump yourself up to, over to the ordinary income. You might want to spread some of the gain. Let's say I know I'm going to sell some company or some asset for a huge appreciation in the future. Maybe I gift it now to my kids so that if we do get to that point that we're going to reach over that $1 million threshold to bump us into the ordinary gains, I spread it out to a number of family members. Maybe I could avoid that ordinary gain if that comes into play. Charitable remainder trust is another type of planning we can do to stretch out gain or eliminate gain. If you're charitably inclined, that might be something you want to look into. And installment sales contracts. Installment sales contracts, I could sell, and I don't have to pick up that gain until I receive the payment or the proceeds. So if I receive it over a number of years and I die in that term, my heirs are going to take over that term. And if I want to see where the law ends up to be, I can make the election on my extended personal return if I want to sell it and capture all the gain this year, or do an installment sales contract. You have time to make the election to capture all that gain this year on an extended return, which would be October 15th of next year. Gives you some time. So with that, I think I want to turn this back over to Mel and let him wrap up the rest of it.
Thank you, Ava. And I think some important thoughts there. And although, as Jay has pointed out, we're probably not looking at legislation immediately, although I'm going to kick it back to him, and because he does have an update for us. So, Jay, what do you have to tell us?
All right, so this is the bipartisan plan that Joe Biden has now agreed to, which the senators brought to him, and it is track one. And basically, these are the offsets, and excuse me, I'm going to read from my phone. Reduce the tax gap, which is what we talked about. Unemployment insurance program integrity. I'm guessing that means make sure if you're on unemployment, you actually deserve it. Redirect unused unemployment insurance relief funds. There was a $300 plus up that happened with the act. If states are no longer allowing that, that money comes back to the government. State and local investment in broadband infrastructure. Allow states to sell and purchase unused toll credits for infrastructure. Extend expiring custom user fees. Reinstate Superfund fees, not taxes, fees, really, for chemicals. It does not say petroleum, but I don't know how they're going to define that. 5G spectrum auction proceeds. Extend mandatory sequester. That would be when we did the sequester to lower how much money is going out. They want to extend that for the mandatory issues, not the ones that we can actually choose. Strategic petroleum reserve sale. Public-private partnerships, private activity bonds, a lot of bonds to get people involved in this, or states. And macro impact on infrastructure investment, which basically means there's going to be a bunch of hiring. Those people are going to pay taxes. That's more revenue coming in, blah, blah, blah. So that's what's going on with the pay force for that. It's a lot. We'll have to see how this goes through. This is not a bill at all. It is literally bullet points. And so there is no legislation yet. So we'll see what happens with this, but it's got a long way to go. So after that, Mel, it's all yours.
All right. Well, thank you, Jay. And I think that's important to catch up on that. I want to take just a couple of minutes we have left to expand on some of the capital gains discussion that Ava started. As Jay has said, we're not talking about something being enacted today. And so I think it is, but it's important to know that this is something that's out here. It's important, something to focus on. The original proposal, as Ava walked through, was taxing gains in excess of $1 million as ordinary income, with the effective date of gains recognized. And there's an error here. It's gains recognized after April 28, 2021. You can scratch out the on or, but that probably is not that important because there is enormous opposition to the idea of going back to the April 28 effective date. Very little likelihood that that's what we're going to ultimately see as the real effective date. Something that is more likely now. Jay talked about, well, maybe we're going to have to jump through all these hoops, but in fact, maybe we could get back into the Ways and Means Committee, back into the Finance Committee, and get something started. You know, let's say in the fall. That would be a possible alternative effective date. Not to say that this is something that is guaranteed to be a part of any future legislation, but that would be the next opportunity. Obviously, another alternative would be to take it at the end of 2020, or really start applying the rules in 2022. There's also been a lot of discussion about moving that $1 million threshold up. There has been discussion about not converting to ordinary income, but just having a higher capital gains rate. 28% is frequently mentioned. That's the rate that was the rate under President Reagan. And the thought is that, well, you know, maybe it was good enough for Ronnie. It's good enough for us. Also, there is almost certainly going to be some push for a relief for one-time sales or sales of small businesses. That's something that we'll see shake out, but it's also something, if you're in a position, particularly if it's a position where the only major capital gain you're ever likely to recognize is the sale of your business, then that is something that I think we want to keep a close eye on as it develops. Now, there has been, and let's see if I can get, there we go. Oh, no, I've gone too far. There has been some question as to exactly how you calculate the $1 million. There is no detail in any of the proposals, but in talking with the technical staff on Capitol Hill, it's clear that they intend to stack the capital gain last. So, for instance, here let's say we've got a capital gain of $1 million. And in addition to the capital gain of $1 million, we have other income of $500,000. Of the $1 million, $200,000 is going to have to be treated already as ordinary income because of recapture rules. We're selling fixed assets that have no basis, things of that nature. All right. Ordinary income is going to come first. The recapture is going to come second. To the extent that I have not then used up the full $1 million threshold, or whatever the threshold ends up being, the capital gains comes in at the current capital gains rate until my total adjusted gross income gets up to $1 million. Only after that point does the taxation at ordinary rates, taxation at a higher rate, wherever they end up moving against increasing the tax on capital gains, that is where that last tranche stacks. And this is consistent with the way they have done this kind of stacking rules before. And as I say, the technical staff on the Hill seems to just assume that this is naturally the way you would do things. So I think we need to be prepared for the idea that when it comes to doing a calculation, that is how the calculation is most likely to work. A couple of items with regard to capital gains, I also want you to keep in mind. First, for small businesses, particularly for personal service businesses that you may be looking at selling, keep in mind, one of the proposals is a repeal of the exception to the net investment income tax for the capital gains on the sale of an active interest in a partnership or S corporation. So we're not talking just about going from 20% to 37 or 39.6%. Add that additional 3.8% on top of it, because there is very much this proposal on the table. The IRS is very focused on this. Be careful with regard to installment sales. And I know that Ava has laid out, I think, a very good place for it. Be careful with taking those installment sales too far in the future. The effective date proposal in the Green Book is gains recognized after such and such a date. Okay, that gains recognized, that means that if 2 years from now, we get an increase in the capital gains rate, or we get a shift over to taxing it as ordinary income when it falls in the wrong place, then that gain that otherwise relates to a sale that took place prior to the effective date change might still be subject to the changed amount. Obviously, paying tax tomorrow is better than paying tax today. And certainly if you can use the installment sale technique to spread out the gain and stay away from the $1 million threshold, that would be a very positive use. But be careful of throwing a lot of money out there where we don't really know what the rules are going to be. Finally, there is no binding contract exception in the proposal. Not surprising. That is the kind of thing that is typically negotiated and is typically added as an exception at the end. But be thinking about how this can affect. So if you are engaging in a transaction that is trying to lock in your gain today before any of this potentially comes about, be sure that your binding contract is really binding, or else you're going to be faced with the possibility of hiring a lobbyist to come down and talk to Congress and explain why your not quite so binding contract really should be accepted as well. And obviously there is no guarantee with respect to that. With that, I guess I've gone a couple of minutes over, and I apologize for taking the extra time, but thank you so much for joining us here. We will be back with another quarterly update this fall. Hopefully we'll have some more developments to talk about, despite that huge white space we talked about in the congressional calendar. And if things emerge in the meantime, we will schedule something special to cover that. And as always, feel free to contact us. Generally, email is the safest way to get through, because the phones tend to back up. But feel free to contact any of the three of us if you have a question that we were not able to get to today, or one that occurs to you in the future. And with that, I'm going to turn it back and thank you all for attending.